Welcome to the deep dive. For, well, thousands of years, humanity's really placed its trust, its wealth, its whole concept of enduring value in, one thing, gold.
Hmm.
From pharaohs hoarding it to central banks stockpiling it, gold's been the ultimate tangible store of value, stable, scarce, accepted everywhere.
Absolutely.
But what happens when a new challenger pops up? Not dug from the earth, but born from, code and cryptography,
Yeah,
aiming for that exact same throne.
indeed. The 21st century gave us Bitcoin, didn't it? And
Yes.
It's often called digital gold.
Right.
And that comparison isn't just, a kitschy phrase. It actually speaks to Bitcoin's design scarcity, immutability.
Okay.
But the real question, the critical one for anyone looking long-term, isn't just can we call it digital gold, but can it actually achieve parity with gold? Not just in name, but in, cold, hard market cap. And how would that even happen?
That is precisely the huge question we are tackling today in this deep dive. We're unpacking a really fascinating paper from Gemini. It's dated September 8, 2025, and it's called Bitcoin and Gold Parity, a bullish 2045 forecast. Now, this isn't your typical, buy this now tip sheet. This is a serious analytical look at a plausible future, one where Bitcoin isn't just some niche thing, but maybe a co-equal to gold.
And what I find particularly compelling about this paper, what makes it really stand out, is how it deliberately avoids those simplistic this will happen predictions.
Right.
It actually embraces the uncertainty. Instead, it very carefully maps out a bullish but plausible scenario,
Yeah.
one where Bitcoin's market cap gets close to gold's by 2045.
Okay, bullish but plausible.
Exactly. And this isn't just a guess. It's derived as the 75th percentile outcome from a really complex methodology. We're talking 10,000 Monte Carlo simulations.
10,000, wow.
Yeah, it's a huge number. And this kind of probabilistic approach, it's absolutely essential when you're looking at these long-term, high-uncertainty forecasts in, well, a financial world that changes so fast. It gives you a whole spectrum of possibilities, not just one crystal ball prediction.
So if you, our listener, have ever wondered about Bitcoin's, ultimate potential or how it really stacks up against gold's thousands of years of dominance, this deep dive is definitely for you. We are going to systematically break down exactly how the Gemini paper got to these, frankly, eye-opening projections. We'll cover the model, how it projects that potential $6.45 million Bitcoin price.
Which is a headline grabber for sure.
Right. And also the real-world ripple effects, like how it could totally transform companies like Strategy Inc., formerly MicroStrategy.
Yeah, the MSTR case study is fascinating in itself.
We're not just throwing numbers at you. We want you to get the why behind them, the how they were calculated, and what it all could actually mean for the future of finance.
Our mission here is really to guide you through these quite intricate models and the critical assumptions they rest on.
Assumptions being the key word there.
Absolutely. We'll explore the why and the how so you walk away not just with, some big figures, but with the deeper, more nuanced understanding of this complex dance between technology adoption, economics, and market behavior. All the things that could reshape what value even means over the next couple of decades. It's about giving you the tools to think about the future, not just telling you what it will be.
Okay, so let's start at the beginning. The foundation, physical gold. It's been humanity's go-to store of value for millennia. History, cultural weight, you can touch it, weigh it.
Tangible.
Exactly. Why has gold held this top spot for so long? What are its sort of core strengths that have kept it there through, countless empires and economic crises?
Well, gold's legacy is, you're right, almost unparalleled. Its strength really comes from a powerful mix of its physical nature and, well, history. Firstly, it's incredibly durable. It doesn't rust, decay, tarnish. It just lasts, preserves its physical form over huge timescales.
Right, lasts forever.
Pretty much. Secondly, its scarcity. Now, it's not absolutely fixed like Bitcoin's supposed to be, but it's naturally limited by geology. Finding and mining new gold is hard and expensive. That natural limit is crucial.
Yeah, I can't just print more gold.
Exactly. And third, and maybe this is the most important, it's universal acceptance. A shiny yellow metal has just been seen as valuable across so many different cultures and economic systems for thousands of years. That makes it instantly liquid, instantly trusted, pretty much anywhere in the world.
That universal recognition is huge.
It is. But what really cements its role, especially in modern times, is its non-sovereign nature.
Ah, okay. What does that mean exactly?
It means it's not tied to any single government's decisions or, central bank printing more money. It stands apart from fiscal policy.
Gotcha. Outside the system.
Right. And that makes it the traditional safe haven asset. When economies get shaky, or there's political turmoil, or inflation runs wild, people often turn to gold precisely because it's outside those national systems. It's neutral,
Yeah.
independent of government, debt, or politics. It's
Yeah.
like the ultimate in case of emergency asset, a
Yeah.
real anchor when things get rough.
That non-sovereign point feels absolutely critical. It's not just shiny and rare, it's politically neutral, a hedge against, well, governments messing up.
Exactly.
So if gold is the sort of analog answer for a safe haven, how does Bitcoin, which is arguably even more explicitly non-sovereign and decentralized, how does it try to carve out a similar or maybe even better space in that same toolkit? What are the parallels that fuel this whole digital gold narrative?
Well, the parallels are, conceptually at least, quite striking, especially when you think about those core properties we just discussed.
Okay.
Bitcoin, like gold, has perceived scarcity. Its supply is capped by its code at 21 million coins. That's a hard limit, arguably even scarcer than gold, where we keep finding a bit more.
True, a genuinely finite supply.
Right. It's also unforgeable because of cryptography. You can't just whip up counterfeit Bitcoin. And its decentralized structure is key. Theoretically, this makes it resistant to censorship, seizure, and inflation caused by, say, a central authority deciding to print more, much like gold is resistant to state manipulation.
So the same problems, potentially a digital solution.
That's the argument. For its supporters, it offers a modern digital fix for the issues gold has traditionally addressed, but maybe with added perks like easier division, portability, and that censorship resistance that physical gold doesn't have quite as strongly. But, and this is important, the Gemini paper is careful here, emphasizes this isn't a guaranteed outcome. The narrative is strong, sure, but Bitcoin's market behavior is still, complex and evolving.
Still pretty wild sometimes.
Exactly. It shows signs of being a potential store of value, scarcity, immutability, but also, undeniably, signs of being a high-risk tech asset. Look at the volatility. It's relatively new compared to gold's millennia-long track record.
Fair point.
So it's not a perfect one-to-one comparison. But the idea is digital, global, non-sovereign asset are powerful drivers. The big question is whether those theoretical pluses can mature into real-world stability and value.
And this is exactly where the paper gets really interesting, isn't it? It moves beyond just comparing features. It explicitly avoids what it calls a simplistic deterministic parity principle.
Yeah.
What I find really compelling about that is it's not just saying Bitcoin will equal gold. It's acknowledging it's not that simple. Can you unpack why a deterministic model, like a single straight line prediction, just doesn't cut it here, especially for something this long-term and, frankly, speculative?
That's a great question, and it really hits on the paper's intellectual honesty. A deterministic model, basically assumes put in fixed inputs, get out fixed outputs. It gives you one single definitive prediction.
Like a fortune teller.
Kind of. And in complex, random systems like financial markets, that approach can give you a false sense of certainty, especially forecasting 2 decades out for a relatively new asset like Bitcoin. There are just too many variables, too many unknowns, too many potential black swan events to rely on one single path.
Right, you can't predict every twist and turn.
Exactly. It's like trying to predict the exact weather on this date in 2045.
Yeah.
Impossible. This paper's approach, though, it acknowledges that uncertainty head on. It embraces it. It doesn't ask what will Bitcoin's price be. It asks something more nuanced. What's the potential upside for Bitcoin's value if its adoption follows this known S-curve pattern for tech, and if market conditions are generally favorable?
Okay, so it's exploring a specific, optimistic path among many.
Precisely. By looking at a plausible bullish scenario, the 75th percentile outcome from that huge stochastic model, it gives us a more realistic yet still optimistic exploration. Remember, 75% of the 10,000 simulated futures ended up at or below this level. So while it's bullish, it's not the absolute wildest outcome. It's a strong upper quartile result that considers thousands of possible futures. It's just a much more responsible way to handle the complexities of long-term financial forecasting.
Okay, that makes a lot more sense. Mapping possibilities, not just predicting one point. It feels more grounded in reality. Now, you mentioned 10,000 Monte Carlo simulations. For listeners who maybe aren't deep into financial modeling, can you break down what a Monte Carlo simulation actually does and why run so many 10,000 seems like a lot for this kind of forecast?
Sure. A Monte Carlo simulation is basically a computational technique, a really powerful one, used to model systems where randomness is a big factor.
Yeah.
And financial markets, definitely full of randomness.
Understatement of the year.
Right. So instead of calculating one single precise result, it runs thousands, or in this case 10,000, realizations. Each realization is like a possible future path for the variables involved, each one based on slightly different random inputs. Think of it like rolling a pair of dice thousands and thousands of times to really understand the odds of rolling a 7, rather than just predicting the outcome of the next roll.
Okay, like playing out the future again and again.
Exactly. And the value of running 10,000 separate simulations is huge. It allows the model to build a comprehensive probability distribution of potential outcomes for both Bitcoin and gold. It's not about pinpointing the future. It's about mapping the range of possible futures and how likely each one is.
Got it.
As we said, markets are stochastic. They involve randomness. A deterministic model just ignores that. By simulating thousands of different price paths, each with random fluctuations built in, the model essentially stress tests its own assumptions against that randomness. And then, choosing the 75th percentile as the bullish base case means we're looking at an outcome that's optimistic, yes, but still falls within the upper quarter of the plausible scenarios the model generated. It gives us a robust, optimistic scenario that, according to the model, has a credible chance of happening. It's a method for understanding potential and risk across a whole landscape of futures.
That's a really helpful way to think about it, mapping the landscape. So with that simulation approach, how do they model something like gold? It's established, has historical patterns. Like, it's not purely random, is it?
No, you're right. Gold isn't just random noise. It has historical trends in terms of growth and volatility, and the model needs to capture that. For gold, they use a standard technique in finance called geometric Brownian motion, or GBM.
Okay, GBM. Sounds fancy.
It does, but the idea is pretty straightforward. It models prices by acknowledging two main things. First, assets like gold tend to drift upwards over the long term. That's the drift part. And in the paper, they calibrate this based on gold's historical average annual return, which they peg at 6.35%.
Yeah. So that's a general upward trend.
Exactly. And this is crucial for long-term forecasting, that growth isn't a smooth, predictable line. Markets jump around. So GBM adds a random walk element. This is where volatility comes in, measured by standard deviation. For gold, they use its historical volatility of 17.42%.
So drift plus random wobbles.
That's a great way to put it. For every little time step in each of those 10,000 simulations, a random factor gets introduced. Think of it like gold's long journey. The overall direction is up, the drift, but the path includes unexpected bumps, dips, and surges, the random volatility. The math equation, sim plus stun, just formalizes that. Bose is price, is drift, is volatility.
It's degree. That's the random part.
That's the random dice roll, exactly. It's a random variable drawn from a normal distribution for each step. It ensures every simulation creates a unique, plausible price journey for gold over the next 20 years, reflecting both its history and market randomness. It gives a realistic range, not just one average line.
Okay, that makes sense for gold balancing history and randomness. But Bitcoin, it doesn't have millennia of data. Its value seems different. The paper models it from the demand side. What does that actually mean, and why is that a better way to think about valuing a newer digital tech asset like Bitcoin?
Modeling from the demand side is absolutely the right call for Bitcoin, and it shows a deep understanding of how these digital network assets work. Unlike, say, a company making profits or a commodity like oil with industrial uses, Bitcoin's value is fundamentally tied to how many people want it, trust it, and use it, collective belief and adoption.
So it's about the users, not inherent properties.
Largely, yes. The value isn't dug out of the ground or generated by selling widgets. It accrues because of the network effect and its perceived usefulness as a new kind of monetary technology. The demand-side approach acknowledges this shift.
Okay, so how do they start? Where does the demand come from?
The first step is defining the potential market. What's the total addressable market
Right.
for store of value assets? And they think big here. It's not just the market cap of gold.
Right.
It includes a much broader slice of global wealth
Hmm.
held for preservation, things like government bonds, maybe high-end real estate, other financial instruments, and gold.
Hmm.
The paper estimates this huge pool at roughly $500 trillion.
500 trillion. That's enormous.
It is, and that massive number serves as the ultimate theoretical ceiling. Bitcoin isn't expected to capture all of it, obviously, but it represents the total potential pool of value it could tap into if it becomes a dominant global store of value. It frames Bitcoin not just as an alternative to gold, but potentially as a new layer for global wealth itself.
Okay, $500 trillion is the potential ocean. But how does the model predict how much of that ocean Bitcoin actually, captures? We hear about the S-curve a lot with new tech. How does that fit into projecting Bitcoin's adoption?
The S-curve is absolutely central here. It's a really well-documented pattern for how new innovations spread. Think about, I don't know, radios, TVs, the internet, smartphones.
Yeah, starts slow, then explodes, then levels off.
Exactly. Slow initial growth with early adopters, then a period of rapid, almost exponential acceleration as it hits the mainstream, and finally it plateaus as the market gets saturated. The model applies this exact pattern to Bitcoin's projected penetration into that $500 trillion store of value TAM.
How does it do that mathematically?
It uses a specific formula, logistic growth function, NEL, 1 plus EKTT.
Okay, break that down for us.
Sure. NDL simply the number of Bitcoin users at a given time T. L is maybe the most crucial assumption in the whole model. It's the maximum potential market size, the ceiling for Bitcoin's adoption. In this bullish case, the paper assumes Bitcoin penetrates 5% of that $500 trillion TAM.
So 5% of $500 trillion, still huge, but not everything.
Right, a significant slice, not the whole pie. Then K is the growth rate. How steep is that S-curve? How fast does adoption accelerate? And T is the midpoint, the inflection point where growth is fastest. This S-curve formula is then used dynamically in every single one of those 10,000 simulations to project user numbers year by year. It gives this evolving picture of adoption unfolding over time.
Okay, so the S-curve projects user growth. But how does more users translate into higher value? Is that where Metcalfe's law fits in, connecting user numbers to market cap?
Precisely. Metcalfe's law is a classic concept from network economics, often talked about with things like the telephone network or the internet.
Right, the value goes up way faster than the number of users.
Exactly. It states that a network's value, V, is proportional to the square of its number of users, N, so VN3. Each new user adds value not just by being there, but by increasing the number of possible connections and interactions across the whole network.
And how does that apply to Bitcoin as a store of value? It's not like we're all sending emails on the Bitcoin network.
That's a great point. For Bitcoin, the network effect isn't just about communication. It's about utility, security, liquidity, and acceptance as money, or a store of value. Think about it. A store of value needs to be easily bought and sold, liquid, trusted, secure, and widely recognized.
Makes sense.
As more people, companies, maybe even institutions join the Bitcoin network, its usefulness for transferring and storing value increases exponentially. There are more counterparties to trade with, potentially more financial products built on top of it, and its security arguably grows too, as we'll get to. Perceived legitimacy grows with every new user. It becomes this self-reinforcing network of trust.
So the connections are the value in a monetary sense.
In a way, yes. It's a powerful driver for market cap. And this is a key difference from gold, right? Gold's value doesn't really increase just because more people hold it, not in the same network sense. Bitcoin's value, according to this model, is directly amplified by the expanding user base and the utility that brings. It's like a living, evolving store of value.
That feedback loop is fascinating.
Okay, but for any store of value, especially a digital one, security is absolutely non-negotiable. You wouldn't park your life savings in something easily hacked. How does the model factor in Bitcoin's network security? And how does that link back to the price?
Security is fundamental, maybe even more critical for Bitcoin than for gold, where security is about, physical vaults. For Bitcoin, security is built into its decentralized design. The model specifically incorporates Bitcoin's hash rate.
Right, the computing power securing the network.
Exactly. The hash rate is a direct measure of how much computational effort miners are putting in to validate transactions, add new blocks to the chain, and generally make the network resistant to attack. A higher hash rate means it's exponentially harder and more expensive for anyone to mess with the ledger.
Okay, so high hash rate equals high security.
Generally, yes. And here's where another positive feedback loop kicks in, which the model captures. Our rising Bitcoin price, driven by that S-curve adoption and Metcalfe's law, makes mining more profitable.
Higher profits attract more miners, or encourage existing miners to invest in more powerful hardware. That leads to more computing power joining the network, which pushes the hash rate up.
Which makes the network more secure.
Exactly. And a more secure network boosts investor confidence, making Bitcoin more attractive as a safe place to store value which can then feed back into the price.
A virtuous cycle. Value drives security, security enhances value.
Precisely. It's an elegant system where economic incentives align with network security, strengthening Bitcoin's credibility as a store of value over time.
That's a powerful mechanism. But let's be real. The world isn't smooth sailing. We have crashes, crises, unexpected political moves, those black swans everyone talks about. Real-world risks are inevitable, especially looking out 20 years. How does the model even try to prepare for those unforeseen high-impact events? Because ignoring them would make the forecast feel, well, a bit naive.
You're absolutely right. Ignoring black swans would be a major flaw. This paper tackles that directly with a dedicated risk module. It's designed to simulate those low probability but high impact events.
Okay, how does that work in the simulations?
In each of the 10,000 runs for each year, there's a small probability the paper uses subjective estimates between 1% and 5% annually that one of these shocks hits. It ensures the model doesn't just operate in a perfect, risk-free world.
What kind of shocks are we talking about?
They model a few key types. First, regulatory shocks. These represent major government actions. A hostile event could be something like a coordinated ban by major economies, think the US, Europe, that would hammer Bitcoin's adoption rate and likely shrink its perceived total addressable market.
Ouch.
Big ouch. Conversely, a favorable event like clear supportive regulations, maybe widespread institutional adoption, or even a country making it legal tender would boost adoption and the TAM. Huge potential swings either way.
Okay, regulatory risk. What else?
Second, technological shocks. This is where the Q-Day scenario comes in.
Quantum computing breaking encryption, the big scary one.
That's the one. The model gives it a very low annual probability. But if it did happen, if a quantum computer arrived that could crack Bitcoin's cryptography, the impact would be immediate and catastrophic. It would trigger a massive, instantaneous price collapse, reflecting a total loss of confidence in its basic security.
Game over, essentially.
Pretty much, unless a quantum-resistant fix could be rapidly deployed and trusted, which is a whole other challenge.
Okay, regulatory, technological,
Yeah.
any others?
Yes. Thirdly, market crises. These simulate broad global financial meltdowns like 2008 or the COVID crash in 2020. Based on how Bitcoin behaved historically in those events, this shock temporarily makes Bitcoin trade more like other risk assets. Its correlation with, say, the S&P 500 spikes, leading to sharp price drops if people sell everything.
Right, the correlation one phenomenon.
Exactly. But here's a key distinction the model makes. In that same crisis scenario, the shock simultaneously boosts the price of gold due to the classic flight to safety.
Ah, interesting. So they react differently in a crisis.
According to the model, yes, reflecting their current roles. So this whole risk module is crucial. It stress tests the projections against the messy, unpredictable reality of geopolitics and market panics.
Okay, so after all that heavy lifting, the 10,000 simulations, demand modeling, S-curves, Metcalfe's law, and factoring in those black swan risks, what's the bottom line? What does this 76th percentile bullish outcome actually project for Bitcoin and gold way out in 2045? Let's hear the big numbers. The $6.45 million question, indeed.
All right, the headline figures from that 75th percentile bullish scenario are, well, pretty staggering. And again, these come out of that rigorous probabilistic process. For the year 2045, Bitcoin's market capitalization is projected to reach $194.29 trillion.
Right. Trillion with a T.
With a T. It signifies a massive reevaluation of its place in the global financial system.
And gold, does it just disappear?
Not at all. Gold's projected market capitalization also sees significant growth, reaching $145.52 trillion.
So gold keeps growing too.
Exactly. Gold continues its long-term appreciation. But what these numbers really highlight is Bitcoin closely approaching parity with gold's market cap, essentially becoming a co-equal global store of value, at least in market size terms.
And what does that mean for the price per Bitcoin?
That market cap translates to an implied Bitcoin price of approximately $6.45 million per coin.
$6.5 million for one Bitcoin.
That's the projection in this scenario. Just to give it another comparison, it would mean one Bitcoin would be worth roughly 12.42 kilograms of gold, a huge shift from today, placing it among the most valuable assets globally.
That $6.45 million figure is honestly hard to fully process. Coming from where we are now, it implies just incredible, sustained growth. How does the paper map out that journey? It can't just happen overnight in 2044, right? What are the key milestones along the way?
Absolutely not. It's projected as a steady, compounding climb over 2 decades. The paper details year-on-year projections consistent with this scenario, driven by a strong compound annual growth rate, CAGR, of 21.4% for Bitcoin versus 7.7% for gold.
Okay, 21.4% CAGR for Bitcoin. That's hefty.
It is. Let's walk through some milestones to see how it unfolds. It starts from around $129,704.61 per Bitcoin in 2025, which is already a big jump from present levels, mind you.
Okay.
By 2030, just 5 years later, the projection hits $342,020. So well over a third of $1 million, showing that initial S-curve acceleration.
Right, the steep part of the curve.
Then by 2035, another 5 years, it's projected at $902,133.72, nearing that $1 million mark per coin. A totally different asset class by then.
Definitely.
The growth continues strongly. By 2038, it could reach $1,614,107.14, crossing $1.5 million.
Okay.
By 2041, it's projected at $2,887,941.60, and almost $3 million.
Getting closer.
And finally, that leads to the $6,273,310.50 projected for 2045 in the detailed tables. What's its projected price per kilo? For gold, starting from around $116,851 per kilograms in 2025, it's projected to reach $514,907 per 26 cents per kilogram by 2045. Also significant growth, but clearly different trajectory than Bitcoin in this bullish scenario.
Got it. So, sustained strong growth for both, but exponential for Bitcoin in this particular future. Crucially, though, this is the 75th percentile outcome.
Crucial reminder, yes, it's one optimistic but modeled as plausible future out of many. Not a guarantee.
Right. So those are the big long-term milestones. But, for a lot of listeners, the next year or two feels more tangible. Does the same bullish scenario give any clues about Bitcoin's price in the shorter term, say from September 2025 through August 2026? What kind of momentum does the model expect then?
Yes, the model does provide that level of granularity. It offers monthly projections that are consistent with that overall bullish growth rate. So looking at that specific time frame, it projects Bitcoin starting around $147,474.14 in September 2025.
Okay.
And from there, it shows a steady, fairly consistent climb over the following 12 months. By August 2026, the projection reaches about $176,012.76.
So still significant growth, even month on month in that scenario.
Exactly. These near-term figures show that the model anticipates a consistent upward trend, part of that larger compounding journey. It's not predicting wild, unpredictable swings day to day, obviously, but a sustained momentum driven by that underlying adoption curve gathering steam even in the relatively near future. It gives you a feel for the expected pace within this specific forecast.
Okay, so if Bitcoin does hit these kinds of valuations, becomes this dominant global asset, the implications are obviously huge, way beyond just the coin's price. The paper uses Strategy Inc., again, formerly MicroStrategy, is a really interesting real-world case study. What makes MSTR so unique here? Why focus on them specifically?
Strategy Inc., or MSTR, is genuinely a one-of-a-kind company in this context. They are by far the world's largest public corporate holder of Bitcoin. They fundamentally pivoted their business.
They really went all in, didn't they?
They absolutely did. They pioneered this Bitcoin treasury company model. They essentially decided their primary business was no longer just software, but acquiring and holding Bitcoin as their main treasury reserve asset, using both equity and debt financing to do it. It was completely unprecedented for a major public company.
A massive bet.
A massive strategic bet. And the paper projects that in this bullish Bitcoin scenario we've been discussing, MSTR's role could morph from just being a smart company holding a lot of Bitcoin into something much, much bigger, potentially a de facto central bank for the digital economy.
Wow. A de facto central bank. That's a profound shift.
It really is. It implies moving from a corporate strategy to becoming potentially a core institutional piece of a whole new financial system built around Bitcoin. They wouldn't just be holding the asset. They could become a critical gateway and institutional layer for the asset.
Okay. De facto central bank. That sounds like something incredibly difficult to value using normal methods. How do you even start putting a number on a company potential transforming like that? Surely a simple price to book or premium to NAV doesn't capture that kind of systemic role.
You've hit on one of the paper's most fascinating and speculative points. How do you value an entity that might become a foundational pillar of a new financial order? The paper explicitly says traditional methods like looking at their software business cash flows, or even just slapping a premium onto the value of their Bitcoin holdings, their net asset value or NAV, fall way short.
Right. They don't capture the bigger picture.
Exactly. They miss the potential systemic importance, the network effect of MSTR itself within a Bitcoin-centric economy. So the paper proposes a much more conceptual and admittedly bold valuation model, the central bank multiplier.
Central bank multiplier. Okay, intriguing. How does that work?
It works by drawing an analogy, a powerful one. It compares MSTR's potential future role to that of existing sovereign central banks. Specifically, it looks at major economies, the US, Eurozone, China, Japan, and calculates a ratio. It compares their M1 money supply, basically readily spendable money, to the value of their official gold reserves.
Okay, so money supply divided by gold reserves. What does that ratio represent?
In essence, it represents the kind of monetary leverage or economic weight that a core reserve asset, like gold, underpins for a national economy. The idea is that the economy built on top of the reserves is much larger than the reserves themselves.
Ah, I see. The reserves act as a foundation.
Precisely. And in this framework, the paper suggests MSTR's publicly traded equity wouldn't just represent ownership of Bitcoin, it would function more like a liquid regulated claim on those underlying Bitcoin reserves, similar to how a central bank's currency or its liabilities are ultimately claims on its reserve assets, like gold.
So MSTR stock becomes like a proxy for institutional access to Bitcoin reserves.
That's the core idea. It's valuing the function, the stability, the institutional access MSTR could provide to the whole digital economy, not just the raw value of the coins it holds.
Okay, it's a conceptual leap, but I see the logic. So what's the actual number for this multiplier? And what happens when you apply it to MSTR's projected Bitcoin stash?
Based on projecting the M1 money supply and gold reserves for those major economies out to 2034, the paper calculates this central bank multiplier to be 20.42x.
20 times. That's a hefty multiplier.
It's huge. Now let's apply it. The paper projects MSTR's Bitcoin treasury could be worth $2.38 trillion by 2034 in this bullish scenario.
Okay, $2.38 trillion in Bitcoin.
Now apply that 20.40x multiplier to the $2.38 trillion treasury value, and you get a theoretical market capitalization for MSTR of, wait for it, $48.6 trillion.
$48.6 trillion for one company.
48.6 trillion. It's an almost unbelievable number, larger than almost any company today, larger than the GDP of many countries. It reflects that idea of MSTR becoming this absolutely indispensable infrastructure layer for a massive digital economy.
That's staggering. Okay, $48.6 trillion market cap. But MSTR has been issuing shares like crazy to buy all that Bitcoin, right? Diluting existing shareholders. How does that affect the actual projected stock price per share?
An excellent and crucial point. That dilution has to be factored in. MSTR has indeed consistently issued new shares to fund its Bitcoin buys. The paper projects this historical rate of share issuance forward and estimates MSTR could have around 2.88 billion diluted shares outstanding by 2034.
Okay, nearly 3 billion shares.
If you take that mind-boggling $48.6 trillion projected market cap and you divide it by those 2.88 billion projected shares, and you get a projected stock price for MSTR of approximately $16,875 per share by 2034.
$16,875 per share. Wow.
Yeah, indeed.
Yeah. Considering MSTR's stock price today is what, around $330 or so, to get to nearly $17,000 by 2034. That's a compound annual growth rate, CAGR, of 6.
Let me see.
Roughly 54.8% per year for 9 years.
That's the calculation, yes. 54.8% CAGR.
That sounds almost impossible, like too good to be true territory for any stock over nearly a decade. But the paper offers a comparison rate, a historical precedent to suggest maybe it's not completely insane.
It does, and this comparison is really important for context. A 54.8% CAGR for that long is extraordinary, bordering on unbelievable. But the paper points out it's not entirely without precedent for companies sitting at the absolute heart of a massive technological revolution. The comparison they draw is with NVIDIA.
Ah, NVIDIA, the AI chip giant.
Exactly. NVIDIA achieved a CAGR of roughly 46% between 2015 and 2024. Why? Because it wasn't just growing. It transformed itself into the essential foundational infrastructure provider for the entire AI revolution. It was the pick and shovel play for AI.
Okay, so the analogy is MSTR could become the NVIDIA of the Bitcoin digital economy.
That's the parallel the paper draws. It suggests that a company truly positioned at the center of a fundamental technological and financial paradigm shift, as MSTR arguably would be in this specific bullish Bitcoin future, could, potentially, achieve such monumental growth rates. It frames MSTR's projection not just as a wild guess, but within the context of other companies that have fundamentally reshaped industries by providing the core infrastructure during massive innovation waves. It's about being the indispensable player at the exact right moment on that tech S-curve.
Okay, this model is clearly incredibly sophisticated, way beyond simple trend lines. It paints this rich, multi-layered picture of a possible future. From your perspective, what are its biggest strengths? What makes it feel more robust or credible than some of the, let's be honest, simpler or more hype-driven predictions we often see?
I think its core strength really lies in its comprehensive and, frankly, more intellectually honest framework. It moves way beyond just telling a story or picking a price target. By systematically incorporating those demand-side drivers, the S-curve for adoption, Metcalfe's law for network value, it captures a much more nuanced understanding of how Bitcoin's value could actually grow organically with its use in user base. That feels much more grounded than just extrapolating past price action.
And the risk part.
And the risk part is crucial too. The fact that it explicitly stress tests the projections against those external black swan shocks, regulatory, technological market crashes, adds a vital layer of realism. It means the model isn't just showing us a perfect sunny day scenario. It's actively exploring a range of possibilities that includes major storms. That makes the entire approach feel more resilient, more credible. It's presenting a spectrum, not a single point, and acknowledging the bumps along the road. It's really a tool for thinking about possibilities and managing expectations, which is invaluable.
So it's powerful, detailed, complex, really compelling. But like any model, no matter how fancy, it has to have limitations, right?
Yeah.
Sensitivities. No model predicts the future perfectly. What are the really crucial caveats listeners need to keep in mind when they hear these huge numbers? Where are the biggest assumptions or potential weak spots?
Absolutely. And to its credit, the paper is pretty upfront about its limitations. The conclusions, while derived through this robust process, are highly sensitive to the initial settings and core assumptions. This is where critical thinking is essential for you, the listener.
Okay, like what specifically?
Well, first and foremost, those total addressable market, TAM, and adoption assumptions. That $500 trillion TAM figure, and especially the assumed ceiling for Bitcoin's adoption, that baseline assumption of capturing 5% of the TAM, those are huge judgment calls.
Right. What if it only captures 1% or 10%?
Exactly. If Bitcoin's ultimate penetration is significantly different from that 5% assumption, the entire final price distribution, including that $6.45 million 75th percentile figure, would change dramatically. That 5% is a reasoned estimate based on other tech adoptions, but it's not a fact etched in stone.
Okay, TAM and adoption ceiling. What else?
Second, the S-curve parameterization. The specific shape, the K growth rate, and the timing, the T inflection point, of that adoption curve are calibrated based on historical data from other technologies. But will Bitcoin follow the exact same path as the internet or smartphones? Maybe not. Unique factors, regulations, competition could make its curve look different.
Fair point. The map isn't always the territory.
Precisely. Third, the risk event subjectivity. The probabilities assigned to those black swan events, Q-day major bands, and their estimated impact magnitudes. Those are, by necessity, subjective judgments. They're crucial for adding realism, but they aren't based on hard empirical data because these events are rare or haven't happened yet. Small changes in those assumptions could significantly alter the perceived risk profile.
Right. Predicting the unpredictable is hard.
Very. And finally, just model complexity itself. Even this comprehensive model doesn't capture everything. Short-term market sentiment, day-to-day trading flows, specific miner economics, beyond just hash rate. Those micro-level dynamics aren't really in there. They can definitely influence price in the short to medium term, even if the long-term macro trends hold.
So bottom line, it's an incredibly powerful analytical tool, maybe one of the best attempts to model this long-term potential. But we absolutely need to remember its results are built on a foundation of carefully chosen, but ultimately still assumptions about a very uncertain future.
Exactly. That's the perfect way to frame it. It is crucial to recognize this is a bullish projection. It represents one potential future out of the thousands the model generated. This whole probabilistic approach emphasizes thinking about scenarios, understanding potential upside and downside, and managing risk, not taking a single number as gospel. It's an exploration of a highly optimistic, yet stress-tested and rigorously modeled possibility. Not a prediction, not investment advice. It's an intellectual framework for understanding what could happen. #tag outro tag.
Wow, what an absolutely fascinating deep dive that was. We've really gone through how this sophisticated multi-factor model projects Bitcoin potentially hitting, that staggering $6.45 million mark by 2045, with its market cap getting remarkably close to gold's.
Hmm.
And it's not just about the price, is it? It's about this potential fundamental shift, a redefinition of what counts as a store of value, how we measure it, and how a purely digital creation could really weave itself into the fabric of global finance. The journey from, like, niche internet money to maybe rivaling gold is just quite something to contemplate.
It really is.
Yeah.
By grounding Bitcoin's valuation in established principles of technology adoption, the S-curve, Metcalfe's law for network value, and then rigorously testing those ideas against major external risks, the paper lays out an optimistic, yes, but also a plausible and well-reasoned scenario for Bitcoin's future role.
Yeah.
And seeing how that could potentially transform a company like Strategy Inc., turning it from just a software firm holding Bitcoin into maybe a cornerstone of the digital economy that really brings home the profound real-world ripple effects this kind of shift could trigger.
Yeah.
It's more than just numbers on a screen. It could reshape financial architecture.
So here's the final thought I'm left wrestling with. If Bitcoin does achieve something like this near parity with gold, if it truly becomes the digital gold its supporters envision, what does that actually mean for the nature of money itself? Does it fundamentally alter how we think about preserving wealth? Does physical tangibility become less important? Or does it simply add another powerful option, a new tool to the existing financial toolkit, sitting alongside gold, real estate, bonds in a more complex, layered system? Where does human trust ultimately settle in a world like that?
And that raises an even bigger, maybe more profound question for all of us, doesn't it? If we reach a future where digital scarcity, created purely from code, can command the same economic weight and trust as physical scarcity, dug from the earth over millennia, what completely new kinds of economic or even social structures might bloom around these different forms of value?
Yeah.
Will that decentralization ethos baked into Bitcoin genuinely challenge and maybe even force a transformation of traditional financial institutions? Or will it, perhaps more likely, just get integrated, maybe uneasily at first, into a more complex hybrid system, changing the rules for some, but maybe solidifying them for others? It really leads us to wonder what other deep-seated assumptions we hold about value, about power, about the role of institutions, about the very nature of property might get disrupted or fundamentally redefined in a future where digital assets can stand shoulder to shoulder with the tangible assets that have defined wealth for centuries. What else might we collectively decide has value? A fascinating question to ponder.